Let's talk about technical analysis. And you see that little warning sign there? I always like to put this up when I talk about technical analysis because a lot of people hate technicals. And, I like them. I'm on the fence, I guess, but I'm trying to expose you to it in case you want to work in the hedge fund industry or you do work in the hedge fund industry and you want to learn more about technicals, or if your portfolio manager cares about technicals. But what I will say is be very careful when you talk about technicals. People love them or hate them. Traders love them. And I enjoy looking at them. But you always want to look at fundamentals, valuation, and catalysts first, and then technicals last. And why is that? Well, the reason is it basically makes you really unemotional about stocks, okay? Technicals can draw a line in the sand and tell you at what price you've got to get out of your position. Okay, it makes you unemotional about stocks. And I've worked for a lot of superb hedge fund portfolio managers over the years, and I can honestly say for the most part, they're very unemotional people when it comes to business, just business. They never get too happy when things go well and vice versa at work, which is actually a very admirable trait because they never get emotional about stocks. And that's hard. That's hard. And so technicals make you very unemotional about stocks. Secondly, technicals allow you to have excellent risk management so that, you always want to limit your losses. And sometimes it's hard to know when to not be stubborn and just give up on a trade. By the way, my kids saw me make this slide and I was kind of having fun with it. What company is this logo from? All right, let's see if you can guess that. That's right, it's Google. How about this one here? It's Shrek, Mike Myers, good fellow Canadian of mine. All right, next up, we've got technicals helps you identify entry and exit levels. Okay, it helps you to kind of identify when you should buy a stock or when you should get out of it, when you should book profit, that sort of thing. Again, it helps you be incredibly unemotional. This, if you haven't guessed already, is from the Smurfs, which I think call it the Schlumpfs or Schlumps in Europe or something. Okay. And this allows you to live to trade another day. And I worked for a brilliant billionaire at a hedge fund that would used to say this always. He'd say, Chris, let's draw a line in the sand and let's live to trade another day. And you'll probably never guess what font that's from there. So trying to make this entertaining, that's all. So live to trade another day. It's very important to draw a line in the sand with technicals. Okay, so let's dive into this a bit deeper and talk about different types of technical analysis or tools that I can give you. And what we'll do is we'll look to draw a couple of charts and try to understand what the entry points and what the exit points should be. Okay, so let's get started. Cool. So here's the first one. There's relative strength index. There's filling the gap. There's the 50-day. Oh my goodness, there's so much information here. What do I do with that? What do I do with all that stuff? And we're going to look at an example of every single one of these tools, okay? Every one of these tools. And please, I'm asking you, I'm begging you, don't make technicals the first thing you ever look at. Fundamentals and valuation always trump technicals, as does a catalyst, a reason to be in a stock. Just use this for position sizing and helping you know when to get in a stock or out of a stock. Okay, we're going to kick it off with the 50 and 200-day moving average. This one's interesting, okay? And this matters, and technicals matter because they're self-fulfilling. I know it sounds silly. It matters because they do. What? Well, it matters because a lot of traders think it matters, and because a lot of computers now are trading instead of us. And the computers are creating more volatility. And let me just give an example. So this white line is the line of the stock. Okay, it's a little bit volatile. And you can see that the red line, which is the 50-day moving average, and the 50-day is a little less volatile because it's an average of the previous 50 days or previous 200 days. Okay, and this is just a hypothetical example. But when the 50-day crosses below the 200-day, people start selling. Okay. They start selling like crazy. And be careful though. It can't just dip a little bit below it. I would usually say it has to dip at least 5% below it. This was kind of a head fake here, so careful of that. So in this case, it becomes self-fulfilling. Fundamentals don't matter right away. Okay. In a company, and this axis should actually be on a monthly basis, but you get the idea. Once a 50-day falls way through the 200-day, then machines take over and computerized trading will obliterate a stock. And there are superb computer-based trading companies like Renaissance Technologies, which has several thousand Linux servers running in parallel looking for patterns. Computers are great because they're highly unemotional. Okay, cool. Next up, we've got what's called an ascending triangle. And again, don't mention technicals to a portfolio manager if they don't like technicals. So it's like religion. It gets really extreme. Anyway, another story. So here's a stock, and you can see it's bouncing in this range, okay? And once it breaks out of this range, then it's off to the races. And if you're short a stock, this is where you cover. Actually, maybe 5% above, okay? And this is a head fake here, so be careful. Anyway, that's called an ascending triangle, okay? That's a pattern people look at right there, broke out. Okay, this one's my favorite. This one works a lot, and I want you to please go and analyze this in historical charts, okay? Usually what happens, and again, this should really be monthly basis, not yearly, but you get the idea. So sometimes a company will gap up, right? 20, 30, 40, 50%, right? And it's usually after hours, right? And the reason you see a gap is because stock market closed, company reported earnings, and they were way better than expected. Therefore, the first trade tomorrow, the next day, is going to be up here. And that's a gap, right? And usually, you don't want to buy a stock here. You want to wait until it consolidates and closes that gap. I know it sounds silly, but you check it out. It works in many occasions. Not all, but many. Okay, so again, you want to make sure that gap is closed and buy the stock here, okay? Buy it here when it closes the gap. Again, this shouldn't be annual, it should be monthly. You get the idea. Look for patterns in real life examples. You'll see there, it happens all the time. Okay, there you go. That's where you should buy it. Great. Then we've got something called the Relative Strength Index, or the RSI, okay? This is the stock. This is the RSI, Relative Strength Index, and it's a mathematical calculation. I'm not going to get too bogged down in what the math is, but it's a mathematical calculation that basically says too many people are buying the stock here, so don't buy it. And down here it says it's oversold. Too many people are selling the stock, so you should buy it here. Don't buy here. Buy here. Same thing up here. Too many people bought the stock. Don't buy it. Right? Just wait. Up here, too many people don't buy it. Back up the truck. Buy it here. Got it? Okay, and so when the RSI, or Relative Strength Index, is 20 to 25-ish, whatever, or below, it's oversold. Too many people are selling it. And when it's around 80, it's overbought, right? And basically what this means is this is math telling you buy a stock when nobody wants to buy it and vice versa. Okay, it's just common sense. So there it's overbought, there it's oversold. Okay, and you can see all the indications there. Great. Stop loss. This allows you to be unemotional about stocks. A stop loss means you sell a stock if it's down a certain amount, maybe 10 or 20% from when you got in, but make sure it violates a risk management, or technical, I should say, covenant. Okay, so, and I've given you plenty of examples of that before, and it helps you just to be unemotional about stocks so you can live to trade another day. I want you to always think in terms of risk reward. If you buy a stock, the upside is your target price, of course, which is based on a PE, or price to revenue, or DCF multiple if you're not a hedge fund guy. And then I want you to think of the downside. The risk is usually a technical level, okay? Risk reward. And so obviously you want the reward, meaning the upside, to be much higher than the risk, the downside. Always think of it in terms like that. So if a stock has 50% upside and 50% downside, it's not a good idea, okay? If a stock has 80% upside and 10% downside, that's a good risk reward. Cool. Cut your losses and always move on. Just don't get emotional. And if a piece of information changes on a stock, which causes the stock to move against you, ask yourself a simple question. Would I put this position on today knowing that piece of new information? And if the answer is no, then cut your losses, move on, okay? Machine selling becomes self-fulfilling after a while, and technicals matter a lot today because of machines, because of computer trading, okay? It becomes really self-fulfilling. And it's out of your control. And the market is always right, not you. Please respect the market always. Live to trade another day. Okay, trend line as a stop. So as you can see here is the low end of the trend line, right? It's a beautiful looking stock. That's the white one there. Here's a trend line. And once it breaks this line, and usually make it 5-ish% below so it doesn't tease you, meaning just kind of break through for a microsecond. And that's your stop loss. And your stop loss value moves up over time, right, as the stock moves up. So in this case, and again, think of this as a monthly basis instead of annually, but annually can work too, whatever. Right here, you could say, okay, so at $70, if it breaks $70 or 68, whatever, then that will trigger a stop loss and I will sell. Okay. And I know it sounds silly if you're a fundamental investor, but the machines are really having a big influence these days on how trading occurs. And I think 5 years from now, computer-based trading is going to be more relevant than it is today. And so technicals will matter more in the future than they do today. Cool. Catch a falling knife. Don't try to buy this stock anywhere here because you're catching a falling knife. Maybe wait till it kind of finds a floor and then trades sideways for a while, and then you can get involved. Just don't try to catch a falling knife. Never worth it. Here's some other things to remember when it comes to technicals. Illiquid stocks own you in a down tape. What's an illiquid stock? An illiquid stock is a company that has a very low volume, okay? It doesn't trade that often. We like to joke and say it trades by appointment. Don't ever buy an illiquid stock because you'll have trouble getting out of it, and that's a widow maker, okay? You become a stockholder. Careful when it comes to shorting companies that have dividends. If a company has a dividend of 5% and you're short it for a year, you have to pay back that 5% dividend. It's deadly. Make sure that the short interest ratio is less than 10 days. What does that mean? Well, when I used to manage my hedge fund, I used to always call up my prime broker, which is basically the firm that lets me trade through them. And I would ask them, what is the short interest ratio or the cost to borrow a certain stock? And if it's less than 10 days to cover or less than, say, 10%, then I usually short it, okay? And this is just a small piece of my entire investment thesis on the company. The reason you don't want to short companies that have short interest ratios over 10 days, meaning the amount of short contracts divided by the volume, is if it becomes a crowded short and everybody's short it and there's just a tiny bit of less bad negative news, then everyone's going to cover and it will rip to the upside and really, really hurt you in your portfolio. So be really careful. Make sure that the cost to borrow is quite low and that the short interest ratio is not too high. And you just don't want to get involved in crowded trades, okay? And shorts, your downside is unlimited, right? The stock can go up forever versus when you buy a stock, you have 100% downside. That's it. Okay, cool. Again, look at the cost to borrow. Make sure it's quite low. Technicals are self-fulfilling, and I want to keep repeating that. They matter because they do, as ridiculous as that sounds, especially when it comes to computer-based trading.